If you're a covered California consumer, you may be a little bit confused on reconciling the subsidies from both the state of California and the federal government. Well, you are not alone. Hi, my name is Kevin Knaus. I'm with InsureMeKevin.com, and there can be some confusion when it comes to doing your California income tax return if you receive the subsidies from covered California that were in addition to, potentially, the federal subsidies. And sometimes you have to pay back the California state ones and you get more federal subsidies, and it's just what's going on. So what I've done is I've developed a couple different scenarios that I'll run through to show how different incomes can create different situations for the subsidy. Now, the subsidy is all based on your estimated modified adjusted gross income. Now, you estimate that when you go into covered California, but as we all know, when you do your tax return, usually your income is a little bit different than what you may have estimated 12 months earlier. There's unemployment benefits. If you're self-employed, sometimes there's losses. So things never come out exactly the way you anticipate it, even if you tried to make income adjustments during the middle of the year. So there can be credits and repayments you have to do with both these subsidies for the state and the federal programs. Now, the California Premium Assistance Subsidy really kicks in it starts at 200% of the federal poverty level, and it makes the health insurance just slightly more affordable. You know, most people are getting maybe 30 or 40 bucks a month. The federal subsidies end at 400% of the federal poverty level, and that's when the California Premium Assistance Subsidy really kicks in for those people that earn up to 600% of the federal poverty level. California does not offer any subsidies between 138% and 200% of the federal poverty level. So all of this information I gleaned from the Covered California Shop and Compare tool for 2020. And if you go there and you put in your numbers and you look at the different plans that are available and you hover over, it says after an estimated monthly savings, it will break down how much is being forwarded to your health plan by the federal subsidy and how much is the state for that income and household size, because it's all based on those factors and the second lowest cost silver plan. That's another video. Also, for this particular scenario that I'm going through now, it is a household of two adults. They're both 55 years old. They live in Northern California. They enrolled in a health plan for the full year, the full 12 months. They were both in the same health plan. And the health plan that they chose, usually the lowest cost silver plan, was always more expensive than the subsidy. The rate was higher than the subsidy. That's important because some people enroll in a bronze plan and the subsidy is larger than the rate. So that limits how much subsidy is being paid on their behalf, either by the feds or California, and it can change some of the numbers, and you may not have to pay back as much, and you may not get as much of a tax credit either when you do your taxes. But those are kind of the assumptions that I needed to lay out. Our first scenario has the couple, and they go into Covered California estimating an income of $55,000, that modified adjusted gross income. And the annual subsidy is $21,115 from the federal government and $376 from California. Now, what Covered California does is they take that annual subsidy estimate and they chop it up into monthly increments, 12 monthly increments, and then they forward 1/12 of the subsidy every month to your carrier. But when you reconcile this on your income tax return, they're just looking at the annual amounts that were forwarded in total for the year. Now, this couple, for whatever reason, their modified adjusted gross income was higher for 2020 at $65,000. This means that their federal and state subsidies were lower because they made more money. It kind of makes sense. That's the curve. So they have to repay $978 of their federal subsidy on their taxes and $231 of the California subsidy because they were only eligible for $144. Scenario 2 has them earning, again, $55,000, the same annual subsidy amount, but when they do their taxes for 2020, their final modified adjusted gross income is only $25,000. So the federal subsidy goes up, lower income, lower consumer responsibility, greater subsidy. However, that $25,000 modified adjusted gross income is in that zone where California offers no premium assistance subsidy. So they gain $4,375 in a tax credit on their federal income tax, but they have to repay $376 on their California income tax return. Scenario 3 kind of just reverses the situation because this is interesting. They estimate that they were only going to make $25,000 for 2020, but at the end of the year, when they did their taxes, they earned $55,000. So now the federal subsidy is lower at $21,115, and they went from zero California subsidy into the zone where they were eligible for a subsidy. Now, they do not have to repay that $4,300 difference to the federal government because there is a repayment limitation within the IRS rules. And so they get to take the $376 on their California income tax payment. The repayment limitation for the feds, here it is. So the maximum, and here's the key, if the income is under 400% of the federal poverty level, the repayment limitation holds. And it's for 2020 a maximum of $2,700. So even though they received $4,300 in excess, subsidies, they only have to repay $2,700. Income scenario 4 has them earning $55,000, but when they go to do their taxes, their modified adjusted gross income for 2020 was $75,000. Well, unfortunately, $75,000 for a household of two is over 400% of the federal poverty level, about 444%. That means they have to repay all of the federal subsidy on their federal income tax return. The good news is that California offers subsidies between 400 and 600% of the federal poverty level, so they pick up an additional tax credit when they do their California income tax return. So that $16,037 that they'll get to take an additional on their California income tax return is the full $16,413 minus what they had already received during the year at that $55,000 income estimate of $376. But again, they have to pay back all of the federal, and so there's going to be that gap there, and that's going to kind of hurt people. They're like, ouch. Now, California also has repayment limitations up to 700%, although the subsidies only go up to 600% of the federal poverty level for the household size. So that's something you need to keep in mind. And if you're self-employed and you get to take the health insurance deduction, boy, that's because you have to go back and readjust your modified adjusted gross income, and it's going to be a mess. Maybe I'll try and tackle that in another YouTube video. So that's kind of how things can ebb and flow with the federal and the California subsidies. So don't be panicked if you have to repay a whole bunch of one because you may get a whole bunch of federal subsidy. You just have to go through it, and this will kind of give you hopefully a sense that, things can be contradictory and conflicting and a little bit confusing when it comes to these subsidies. Well, I'm Kevin Knaus from SureMeKevin.com. Good luck.